Netflix's stock is crashing. The NFLX share price is down by up to 25% after hours on the back of their earnings report. This is amplifying the loss, with Netflix's share price down by over 60% since their all-time highs last year. Investors and analysts are asking, what happens when a growth stock stops growing? And what does this mean for Netflix's story up ahead? This is the first time that Netflix has had a decline in subscribers in over a decade, in more than 10 years. And there have been a range of different reasons that Netflix have put forward about why they had a weaker than anticipated quarter. And then make sure you stay until the end, because we'll unpack some of the opportunities that Netflix may be able to uncover or explore to potentially help them to navigate through this difficult period. But before we unpack the key drivers behind Netflix's weaker than anticipated quarter, and then talk about what this could mean for the Netflix story moving forward, let's start with the raw facts. Looking at the financials, the key metrics, those high-level numbers, they weren't all bad. Revenue was basically in line. Granted, growth was slowing. Of course, Netflix has been known for its strong double-digit growth consistently over this past period. This quarter was around about that 10% mark, but it's been slowing when you look at it over the trend, and they've forecasted and guided for around about 10% for the next quarter as well. EPS was just about in line as well. Operating margins remain strong at around that 25%. However, they've guided for around a 20% operating margin for the upcoming quarter. And cash flow positive. They are generating free cash flow at that bottom line, $802 million of free cash flow. So when you're just having a look at those high-level key metrics, it doesn't look all bad, but the cause for concern and what really started ringing some alarm bells for Wall Street was to do with the subscribers. Of course, Netflix has always been a company that's traded at a rich multiple. It's always traded at quite a rich and expensive valuation, but this has been as a result of its strong and consistent growth rates. However, for the first time in, as we mentioned, over 10 years, Netflix saw a decline in its subscriber numbers, and this is where a lot of the concern has been. So looking at the subscriber numbers there, we can see that Netflix, there was a forecast for adding around about 2 million subscribers for this quarter, with some analysts actually even having it higher than that. However, Netflix actually ended up declining by 200,000 subscribers for Q1. But what was even more concerning for the market was the fact that Netflix actually guided for a 2 million subscriber loss in the upcoming quarter. No one really anticipated this, and now there's a lot of cause for concern about what does this mean for the story moving forward for Netflix. Is this the end of the growth journey? Is this a speed hump in terms of a longer term trajectory that's still on the right path? And where are they going to head from here? And so as we unpack that, it makes sense for us to look at the key drivers of why growth has declined. And Netflix actually provided their 4 key drivers that they've isolated this down to with their earnings report. I'm keen to know your thoughts as we go through these though, so drop in a comment below. Which of these do you think were the key drivers that contributed to it? And what do you actually think this means for the NFLX story too? So driver number 1, as we can see here, they've outlined it with slower than anticipated market growth within their addressable market. So Netflix have defined their underlying addressable market defined as broadband homes. Of course, this is broad. They're not going to be able to capture 100% of this underlying addressable market. But what they have highlighted and pointed out is that they've seen a slower uptake of the market, which they believe a lot of is outside of Netflix's control. They do believe that this is going to hopefully improve over time, but they've highlighted that there are a few different factors that are outside of their internal control. On the second side, this was one that really attracted a lot of attention. It hasn't been called out with such significance before in previous earnings reports, but it's to do with account sharing and the fact that password sharing has been happening. Netflix has around about 220 million paying households, but they believe that up to 100 million additional shared households may be using Netflix that aren't paying for it due to the sharing of these accounts. Obviously then they've outlined that this makes it harder to grow membership due to the sharing. And so this is going to flow through to some potential opportunities that we talk about later on in the video in terms of how Netflix could navigate this. Factor number 3 has to do with competition. Now, this is not new news to anyone who's familiar with the sector. We know that initially the competition was to do with the linear, conventional TV networks versus streaming. Netflix had that first mover advantage. But now as the streaming sector continues to grow rapidly, and Netflix really has built this sector, they've pioneered the sector. We're seeing a number of new entrants into streaming, and Netflix have really highlighted that over the past 3 years, they've seen a significant growth in this area. New entrants include YouTube, Amazon, Hulu. If you think about many of the companies that really succeeded during the pandemic as well, the streaming sector was one that was a real stay-at-home winner. And then on that 4th reason that Netflix have outlined, they've bucketed up into macro factors. Everybody's familiar with the fact that there has been a difficult macroeconomic environment over this past period. From slower economic growth, obviously more difficult comps as well for companies like Netflix, who are stay-at-home beneficiaries with the year-on-years, increasing inflation, which is affecting cost of living, and ultimately as well discretionary spend, geopolitical events too, and Netflix actually did lose up to 700,000 subscribers from suspending their operations in Russia too. And so they've highlighted macroeconomic factors as another bucket that really meant there were significant headwinds for them to trade into on this past quarter. And so now the question is, with Netflix being one of the leading technology names globally, and they've been a true growth story winner over this past decade, can Netflix continue to grow? And if so, where is that growth going to come from? Netflix did provide a bit of an insight into their outlook moving forward over this upcoming period. And so they've stated that their goal is to sustain double-digit revenue growth, which is what they've been known for, and to increase operating income even faster. So to really double down and expand out those margins while continuing to be positive free cash flow generative. They're stating that during this period of slower revenue growth, this was slower than they did anticipate. They're assuming that with no material swings in foreign exchange, they aim to protect their profitability and to manage to a minimum operating margin roughly in line with current levels. And as we mentioned, they guided to around about 20% for the upcoming quarter. And then they are hoping that as they re-accelerate revenue growth moving forward from that, they're committed to steadily growing their operating margin and expanding those margins out. So with all of that context, with all of that understanding, of course, it makes for some pretty bleak reading. It was a difficult quarter. There is nowhere to hide behind that. And in fact, the past few period for Netflix, it's been quite difficult, coming down from a share price of $700 at their peak to now trading in the 200s. The question is, where are the opportunities? What are those growth levers that Netflix could potentially consider? Firstly, intuitively, obviously they're going to be looking at how they can stop the sharing of accounts, or if they can't stop the sharing of accounts, how they're able to accrue revenue from that. So there's the potential opportunities for having users pay for more devices or adding on different accounts that they're utilizing. Potentially they could consider utilizing algorithms to assess for suspicious activity, and that could give them some indications about which accounts may be being used for sharing. Obviously, Netflix has been focusing on international growth. They've got their core market in North America, but they're looking to continue to expand that out. They've been spending heavily on content, like many of the streaming providers have, but they're going to continue to develop out location-specific content. Raising prices is an interesting one. Netflix, as the pioneer and the leader and the creator of the streaming category, has always been perceived to have pricing power. They've been raising prices consistently. However, their last price raise was interestingly because this is the first time we've seen a reduction in terms of subscribers. So the question is, how much of a correlation between that price rise was it versus the other macroeconomic factors that they've outlined? We do know that Netflix traditionally has a more expensive streaming service than some of the other streaming companies. And of course, with increasing competition as well, that is going to impact how many different streaming companies that users may be subscribing to. So this is going to be an interesting dynamic to watch. And something that gets mentioned a lot so far, the internal management and leadership team at Netflix that have been resistant to it. But the question is, do they look to implement an advertising supported tier? This is similar to companies like, say, Spotify, who you can pay for a subscription and you don't have ads, or there is a free-based subscription where you then have to listen to ads between it. Do Netflix look to implement something like this moving forward? And then on the other side as well, alternative entertainment. It's no surprise that Netflix have been investing heavily into the gaming sector. They've bought a number of gaming studios. It's an adjacent market. It's not a direct one-for-one, but entertainment is entertainment. So do they look to double down into this? And if so, what is the crossover and the intersection between the current user base, and how much traction will they start to see as they continue to explore these alternative entertainment opportunities? It's a fascinating time. We know this is just the beginning of earnings season. There is obviously a range of mega cap technology names that are going to report in the upcoming weeks. I'd love to know your thoughts. What do you expect for the earnings season up ahead? What did you make of Netflix's report? Drop in a comment below. We know the streaming wars are just starting to heat up. Many of these companies, many of the traditional entertainment providers are really starting to double down. They're investing heavily into this space, and they're really going into after this business. It's more and more becoming a saturated market. It won't be surprising to see if we see industry consolidation. Obviously, the Netflix was a pioneer, so it'll be fascinating to see how they navigate this period from here moving forward. If you're interested in some more discussions about the market, we'll leave some links to other videos that we've done recently. Thank you so much for joining us. For now, stay well and happy investing.